All right, so welcome to another video. Today I'm going to share with you how to sell puts and make some passive income on high quality stocks that you don't mind owning. And I'll give you a little tidbit on how to sell verticals on that as well. And as I do this, keep in mind, it's not a recommendation to buy, sell, or trade anything, just my opinion after I've been doing this for a little while. I just want to share with you some thoughts and tidbits. And I can also help you out one-on-one if you want to go to my website, grab a coaching session, we can work together. All right, so let's go ahead and kind of get started on this put kind of thing. And how do we make money from selling puts? So ultimately, what you're trying to do when it comes to selling puts is you're really selling insurance on stock, saying that, hey, I'll go ahead and pick up that stock off your hands if it falls to a certain level. So let's go ahead and go to the paper here. So let's say a stock is trading at $180 a share over here, and currently it's trading there. And you'll say, hey, I will go ahead and sell you a put at 150, right? Business comes down to selling, just like Apple sells you phones, grocery store sells you tomatoes. So what you're doing is you're taking this 150 and you're saying, okay, I'm going to go ahead and take that stock at this price level. Okay. So for that, you might get, let's say, $500. So if that stock that's currently trading at $180 per share stays here or above, so it's going to have to stay at your level, you're good. If it drops a little bit, you're still good. Now, if it goes below and then goes back up, you're still good. So what's the point of this put? Well, basically what's happening is that somebody here on this end is insuring a stock. They are going to buy insurance. Now, sometimes, just like in a car accident, you have some, fender benders and stuff like that don't always go through the insurance claim. But here, what you're doing is the same thing. You're insuring it at $150 a share. Now, if that stock at this expiration date, let's say you got 30 days, okay, at this expiration date, if it goes below and stays there, then you will get put that stock for 150. Now, if that stock is trading at 120, you still get it put to you at 150. So in other words, the big risk here is, let's say the stock stands still, you make this $500. Stock goes up, you still make $500. Stock pulls back a little bit, you still make $500. The big problem is that that zone right here, if it goes under this level, okay, under this zone, this 150 zone, if it's here or below, you get the stock put to you. And if it's lower than that, you have to pay a higher price. So in other words, this is a great way to go ahead and sell premium on stocks that you're hoping to go ahead and get assigned eventually. And you're kind of buying the stock for a cheaper rate. But as that stock continues to head higher, you're good with it because you can continue to keep and making money. Okay, so let's take a look at this on the trading platform. Just want to share with you some tidbits here. If we go to our trading platform, this is the Thinkorswim platform. Let's say I wanted to trade Bank of America here. Current stock price is $36.75. You can see it right there. Okay. And it is up 91 cents today. Yay for me. And then what you want to do is say, okay, I want to go and I say, I want to insure this stock 22 days, 15 days, 30 days, whatever your time frame is. But you can see the stock's been going down. And now if it starts heading up, what you could say is I'll take that stock off somebody's hands at $32 or at $34, $35. You get to choose where you want to insure that stock. So here you go into the options world or options segment. And then I can say, okay, well, 36 days out, I'm willing to insure that stock 36 days out. And I'll go in and say, okay, I'll insure it at 33 or 34. Let's say $34 strike. So that means right now the stock's trading $36.77. I'm willing to take that stock for $34. I'll right click, sell a single put on the put side. This is the TD Ameritrade platform, by the way. And I'm just trying to show you the concept. It's not to say, you got to run through this step by step. There's more details on my website if you really want to get into the nitty gritty of this. Okay. And then what we can do is go in and say, okay, here's your risk profile picture. So the white line is today. This is the current line. Green line's at expiration. So if at expiration, this stock at the strike price hits this 34 or lower, I get that stock put to me at 34. But if it doesn't get there, what I end up doing is collecting this 69 cents, which is really each option contract is in 100 shares. So it's basically $69. And you can see that right here. If I zoom in, I make $69 right there at expiration. Okay. Now, every day that stock stands still, I go ahead and collect $2.04. Okay, if it goes up very quickly, I make about $24 for every dollar move up. That's what the delta tells me. Okay, so overall, as long as this stock stays above this price level, I'm good. If it drops below for a little bit and then goes back up, I'm still okay. But if it keeps going down lower, let's say to 32, I get that stock put to me at 34. So what you could do is, as you start seeing this stock, and you want to sell puts on something, it's a good way to do this when, let's say, hey, you start selling some puts here and you make, let's say, $70. You sell some more, $70. $70. So even if the stock pulls back a bit, you might not get in trouble. $70, $70. Eventually, at this point, the stock will get assigned. So right here, you sold some puts. It went up, pulled back, and you get assigned that stock. So then what is it that you do? Well, you could just dump the shares and say, okay, I'm out. I'll dump the shares and then I'll just keep doing that again. Okay. Then it works, then it works, then it doesn't work. So it's a loss there. So eventually you do get the stock put to you and maybe you'll lose out a bit. But what you're trying to do is constantly keep selling the put premium with time as you go ahead and do it. Now, couple quick tips. The first tip is that, number one, when you're selling this put, you're technically really buying like 24 shares of stock. It's kind of what it is. That's what the delta implies. The other thing that I'll tell you is that you could neutralize this a bit by buying a put under there. And this is what I did with this vertical. This is known as a vertical. So I bought a put at 32. That way, if the stock does crash to, let's say, 29, I'm buying a put at 32. And that just kind of limits my downside. So it creates kind of like this vertical diagram. So anyways, it's the same concept where I have sold 3 contracts here. And then right here, you can see I'd make $166, $171 off of that. And then I bought some, so that reduces my profit. So you make only $102. Not a big amount, but just good for example purposes, just to kind of have it right there, just to show you what's going on there. So anyways, those are a couple of insights beyond that, and some things to think about as you go ahead and do this. But that's kind of the way the option strategy works. There's a lot more on my website. You can definitely go to tradersfly.com and check things out. And if you're struggling with this strategy specifically, you can go to the video coaching calls, or even work with me, for a couple weeks on this strategy. So that way you really get it and understand it. Definitely grab yourself some coaching sessions, and then we can work together, because it'll save you a lot of time trying to figure this out all on your own. So anyways, thank you so much for joining me. Truly appreciate it. Enjoy the rest of the week ahead, and I will see you on the next video.